I want to welcome you to the CBER Job Market Symposium. This is a new feature, and we hope to make it an annual feature. So we have 3 candidates. They are selected based on competition. They are like superstar candidates. And one of the objectives is to highlight them and bring them to the attention of recruiters, meaning recruiting in this broadly area of blockchain economics and fintech and areas such as those. So, so the candidates we have today is Nir Chemaya. Nir is sort of economics and finance areas. And then Ruizhe, he is operations, research, and finance and related areas. And Aviv, Yaish, he is in the computer sciences area. I imagine he would be recruiting broadly in that area. So anyway, let me just say a few words about these candidates and their accomplishments. So, you know, one thing, just as a way of context and background, there are a number of deans at different schools saying, you know, we need to hire in the fintech area. So depending on the dean, some deans may be very specific. They might be talking about hiring in blockchain, digital economics, and things like that. Or some deans may be thinking more broadly, you know, data science, AI, ML, you know, including of course, fintech platforms for lending, or blockchain economics, all of that. So, you know, that's going to happen. That's happening more and more. It's happening with respect to MBA programs. It's happening with respect to undergraduate programs and so on. Now, having said that, though, to get a job in the broader areas, which is going to offer a course in fintech, you still have to go through a recruiting audience who may be finance people, who may be economists, you know, data people, and so on. So one of the things I would say is that, you know, it doesn't hurt you to present your material and your job market paper and so on to this kind of an intended broader audience. So I'm hoping I'll see a little bit of that in your presentations. So feel free to, you know, assume that all your audience is not going to be experts in the blockchain area, you know, so you might want to tailor your presentations a little broadly. Okay. Another thing I want to say is that, you know, these guys, they're really good. They're superstars in this area. So if you have any kind of, now I'm talking to recruiters, potential recruiters, faculty members in these, not only fintech area, but also the broader areas such as finance, economics, and so on. So I'm talking beyond just computer science or blockchain people. You know, this might be a good forum to keep tabs on really outstanding candidates. So that's the way I see it. Okay, let me say a little bit about each one of the candidates. So in the order of their presentations, Nir Chemaya Nir is a PhD student in economics in the University of California at Santa Barbara. Nir works heavily in the area of decentralized finance, particularly on decentralized exchanges. Today, he'll be presenting a paper regarding decentralized exchanges that identifies the extent to which investors value the security for which blockchains such as Ethereum are known. Okay, so that is what Nir is going to focus on in his job market paper that he is going to be presenting first. Ruizhe Ja, who I've gotten to know, he is a PhD student at Columbia University. He is a superstar. I've talked about his work to him several times. He has already established himself as one of the foremost researchers in decentralized finance. He wrote what I think to be a seminal paper on decentralized exchanges, which is now a revise and resubmit at the Review of Financial Studies. As you know, RFS is a top 3 journal in finance, and believe me, very, very selective. So this is quite an accomplishment. He has also written the very first economic papers on novel topics such as maximal extractable value, MAVs, which is a big topic, just-in-time liquidity, and proposer-builder separation, PBS. So all of these are sort of a very frontier topics. Ruizhe has been writing some good papers in these areas. So today, he's going to present on price discovery at decentralized exchanges. So Ruizhe is going to go a second. Then we have Aviv Yaish. Aviv is a PhD student in computer science at Hebrew University. He's also a superstar. His work examines the security of blockchains, studying attacks of economic importance. Okay? Today, he's going to present the work that both theoretically introduces several attacks and empirically evaluates their performance. Okay, I'm going to start the presentations. Before the presentations, let me say, you can do 20 minutes presentation. So it's a brief presentation. You can go, a little bit of slack. And then after that, if there is time, we can have some questions from the audience. Okay. All right. Nir Chemaya, Nir is going to share his slides. Okay, Nir, you can take it away.
Okay. Can you see the slides?
Yes.
So thank you so much for having me here. I learned a lot from the CBR forum. And so today I will present my job market paper, Estimating Investor Preferences for Blockchain Security. It's a joint work with Kite, another PhD student from UCSB. Both of us are from the econ department. So let me start with the main idea and back to what we discussed before. So let's think in general about fintech. So imagine that traders face 2 fintech blockchain technologies that one's vulnerability is superset of the others. And a question that we need to ask ourselves, how does one going to perceive this risk? So this is kind of the general idea. And now let's take it a little bit to the DeFi and DEX domain. So the first technology will be Ethereum. We will call it layer 1. what we know about Ethereum is that it's a main blockchain network with a lot of people, a lot of activity, and it's actually reached to a point that it faces scalability challenges. As we know, high gas fees, a lot of users, small amount of transactions per block. So this actually made many people to think about how we can solve the scalability problem. And we have now what we call layer 2 solutions, which can be Polygon, Optimism, and others that mainly want to kind of improve the scalability of the system. But we can think about it that they are built on top of the main system. So that's why we have layer 1 and layer 2. And it can potentially be with some risk, okay? Because it will be less risky. More, they're going
less
to be
secure.
more risk in those systems.
Less secure, right?
Less secure, yeah. So now when we want to dig in a little bit more why, so I think the best way to think about what's going on is what we call the blockchain trilemma, something that coined by Vitalik from Ethereum, which the main idea or the main point, he argued that it's kind of impossible to have a blockchain system that's going to be fully decentralized with high security and high scalability. And this is why both Ethereum and Bitcoin that everyone knows about suffer from low scalability. They can deal up to 30 transactions per second. And if you compare it to Visa and other payment systems that do thousands of transactions per second, you right away realize that there is a scalability issue here. And how we can solve the scalability problem in the blockchain domain, so we have all these L2 solutions. And in order to kind of create a system with high scalability, you need to sacrifice something. You need to do validation process that's going to be faster. You can do it with many technical ways. You can do it with making blockchain network be more centralized. You can do a validation process that's going to be faster. So instead of doing validation to all the transactions, you only pick several of them. But the main point is that in the end, there is some security decentralization risks. So if we want to kind of say something about how L2 are less secure than L1, so like the ideal way to do it is to say, okay, let's calculate the objective risks of each network. The issue it's going to be that it's super complex, many different validation mechanisms. Each one is very hard to understand how it works and to evaluate the risk like a number, like what is the probability of a manipulation in Polygon or Ethereum or whatever. Also, it includes smart contracts and how they run in each blockchain and if it's going to be more secure, less secure. Using of warp token, when you trade on Lightning Network, L2 network, you many times when you want to use, for example, Ethereum on L2, you need to use warp tokens, warp Ether, and this includes a liquidity risk. So it's going to be problematic. The second problem is that we're dealing with kind of trying to evaluate what is the risk of manipulation in the validation system, which is something that unfortunately we have no document, no history about it, because, for example, Ethereum didn't suffer a 51% attack. So we don't know really what is the risk. So we cannot use the frequency probability approach, which is basically using historical data to evaluate the probability of the manipulation. So the only thing that we can do is kind of like estimate traders' beliefs about this security. The problem to do it via surveys in the DeFi domain is that due to the anonymous nature of the DeFi system, it will be very hard to identify, like, if we have a valid data set, if the subjects are real, if we can use this data. And even if we do it, the quality of survey data can be poor. People will say, from 1 to 10, I believe that Ethereum is more secure than Polygon. 8. What 8 means? It's going to be problematic. So our solution is to say, okay, we have a massive trading data from decentralized exchanges. People can trade both in L1 and L2. Let's use this real trading data that capture people decisions, which include their beliefs, and try to back up traders' beliefs. And how we're going to do it? We're going to offer a model that's going to say, okay, if there is no security concerns, how traders should trade in decentralized exchanges when they can choose between L1 and L2. And then using actual decisions, we can compare between the prediction and the actual decision. And if we're going to find the gap, we can use this gap to reveal their subjective beliefs. Second. So our contribution to the literature is, first, there is a lot of papers, both in econ, finance, and computer science mainly, that describe the risks of trading in blockchain in general and L1 and L2. So what we're going to add to this literature is mainly to estimate these concerns. There is a lot of excellent papers about DEX and AMM that we basically use in order to build our model. The added value of our paper is going to be that we added a feature in those models that agent can choose between trading on L1 and L2 in an AMM environment. And finally, we use something that in the economics literature they used a lot in the past, which is basically backup people beliefs using real data by the subjective belief method. And there is many different domains that people use it in the past. So the main idea is that when you have a gap between what people should do in theoretical model and what they do in real life, you can use this gap to back up beliefs. And you can do it in many different domains, like the value of statistical life and others. And we're going to do it in blockchain and networks and security. So going back to the main idea, now we can kind of plug in our research question and the main idea of the paper. So traders face two blockchain technologies, layer 1 and layer 2. L2 vulnerabilities is a superset of L1. So how does one perceive this risk? So first, we're going to give you a model that's going to explain how should one decide where to trade when there is no security concerns. This is going to be what we call the theoretical predictions. And then by using empirical data, we will estimate traders' beliefs about security when we compare theoretical predictions with security concern free to empirical data. So let me go over the model. There is a lot of math there, so due to that I only have 20 to 25 minutes, I'm not going to go deep to the math, but feel free to read it in the paper or reach out to me later if you want. But the idea is we're going to use a representative agent risk neutral model. So basically, traders going to maximize their expected payoff. They're going to deal with a question that they want to trade in decentralized exchange platform, such as Uniswap, and they want to trade token X to token Y. And what they need to take into account is first, the gas fee to execute the transaction. And in L2 is always much lower than L1 by the nature of the L2 solutions. So in L2, it's going to be a few cents. And In Ethereum, it's going to be a couple of dollars. It can even go up to $50. So this is fixed cost. Then we have another element, which is variable cost, which is the exchange rate. So I know that here in the CBR, many people already know about AMM and how they work and CPMM. But the idea is that these pools that people can trade token X and token Y, going to actually determine the exchange rate depend on the liquidity that there are going to be in each pool, which the notation is X1 for token 1 and Y1 for token 2. And the idea is the more liquidity you have, it's going to give you a better exchange rate. And due to the fact that Ethereum exists longer, and we see it in our data, especially in all the big pools, it always have a better liquidity, which offer a better and more attractive exchange rate, especially in big pools. Especially for big transactions, because in big transactions, the magnitude of this effect of the variable cost is even greater. So to conclude about our model, this agent going to need to make a decision. You want to trade a transaction, and you need to decide if you want to do it on L1 or on L2. You need to take into account the fixed cost, which is the gas fee, the variable cost, which is the exchange rate, and another parameter that we're going to add to this model going to be the security one that we want to back up, which is what is traders believes about the probability of losing transaction value when you trade on L2 relative to L1. So this is kind of like the model. Now let's go to the data. So in order to see if indeed like what's going on in reality, we took 1 year of transaction data from 21 liquidity pools on Uniswap protocol, 8 in L1, and 13 in L2, both Polygon and Optimism. It's important to mention that these pools capture the majority of the volume in Uniswap, because and I don't know if people already explore like trading data in Uniswap, but there is many really unknown tokens that people trade, but the volume is very low, and the majority of the transaction is in big pools with very known tokens. So it's end up to be around 20 million transactions. They're worth a lot. You see, $360 billion. So it's a very massive data set. So first, I want to prove the first assumption that gas fee in L2 is indeed lower than Ethereum, and you can see that over the 1 year data, it's always much more. We speak about few cents in Polygon. In Ethereum, recently when the market went down and we have more L2 networks to trade, it's around $5 per swapping transaction. The second assumption that I want to prove is that the pool size, the liquidity on Ethereum is higher than L2, and we can see that the same. It's much higher, more than 100 million in Ethereum compared to Optimism and Polygon. Now let me explain you kind of like what is the theoretical predictions.
Nir, there is a quick clarifying question.
Oh, sure, yeah.
In the real world, can traders split trade between L1 and L2?
Split?
Yeah, can they trade partially in L1 and partially in L2?
Yeah, so it's a good question. So some people ask us in the past, like maybe in order to hedge they can do what you mentioned. They can indeed do it. It's something that we didn't like allow in the model, but later I'm going to show you some like some observation that they are more likely to stick with one.
Okay.
I will show you one result. But
Thank you.
but practically they can.
Okay. Thank you, Nir.
Okay, so let me go and explain kind of like build intuition, what is going to be the predictions of the model, and let's put security aside where there is no security. So let's start with the right. So the idea is that this chart going to show you when someone's going to do $10 or X dollar transaction, how much money going to be left after the transactions.
So Nir, just for planning purpose, you know, you have about 5 minutes, and then you have to start thinking of winding down. Yeah, just keep that in mind.
Okay.
Continue, please.
So basically, the idea is that this is going to show you what's going to left to the trader after he paying gas fees, exchange rate, and so on. So the solution going to be that for big transactions, the variable cost will be the one that's going to push people to get more in Ethereum, because their Ethereum has more liquidity, and it's going to be the one with the higher magnitude. However, when we shift to very small transactions, as you can see here, then the fixed cost going to be the one that's going to have a higher magnitude, and that's going to make that L2, such as Polygon, going to be better. So the solution to for the theoretical prediction going to be that it's going to be switching point solution. In the beginning, for small transaction, you do L2, and when it's become to a very big transaction, you shift to L1 because of the liquidity that we have that is higher in L1. So here we can calculate for each day, for each given pool, and when we compare between Ethereum and Polygon, what's going to be this switching point theoretically with security concern free, so no security aspect at all. And when we look on the actual decisions, what we observe is that actually Ethereum, traders mainly use Ethereum for very big transactions, and Optimism and Polygon for small transactions, and you can see it from the distribution of the transactions. And here it's capture all the transactions that are 10,000 and more. So now what we want to do is we want to find a good way to do an estimation for the empirical switching point. So in order to do estimation for the empirical switching point, what we did, we ran a logistic model for each day using the empirical data. And this logistic going to give us the best empirical switching point that's going to give the lowest false positive and false negative in our classification model. So the idea is it's going to give based on this W, we're going to classify each transaction below is Polygon or Optimism, and each transaction size above going to be Ethereum, and we're going to do it with the minimal false positive and false negative, and with a very good minimal false positive and false negative, we can have a daily empirical switching point. And once we have the empirical switching point, we can put it in the same chart with the security concern free. And what we can see that for each pool that we do it, no matter like if it's USDC and Ether or Bitcoin or whatever, when we compare it between L1 and L2, we have this gap, and always it's below. And when we observe this gap, we say, okay, we can expand this gap by the security aspect that I discussed before. And when we calculate it over time, over many different pools, we get pretty much robust and consistent results. Always the charts look like that we have this gap. Always the numbers are very similar and consistent, and you can see that the confidence interval shows that the security parameter that we back up is very, very small, and I think like here it's around 0.7%, and here it's around 3.3%. And this security parameter basically means what is the probability losing on your transaction value when you trade on Polygon relative to Ethereum, and optimism relative to Ethereum. So given that so how many minutes left I have to conclude? Like 2? Okay. I'm not sure about
2 more minutes. 2 more minutes. Yeah.
Okay, 2 more minutes. Perfect. Okay. So given that I'm a little bit run out of time, I just want to say that in order to make sure that our results are robust, we check that alternative explanation to the gap are not indeed taking place, which is price accuracy, adoption cost, and the value of holding assets on L1 relative to L2. I will be glad to speak about it more in the question parts. So let me conclude. So basically the idea is traders tend to switch to L1 earlier than the prediction with no security. We offer a model that's going to use empirical data to estimate security preferences, and it can explain the gap between the empirical data and the model predictions. Our model suggests that traders anticipate 0.7% almost and 3.3% chance of losing transaction value when you trade on Polygon or Optimism compared to L1. It's very high number if you compare it relative to the 0.3% liquidity fee that you pay for liquidity providers when you trade. And in order to make sure that like other alternative stories cannot explain the gap, we explore if price accuracy, adoption cost, and the advantage of using holding assets on L1 cannot explain this gap, and it seems that it's less likely. And I think like this is kind of the main takeaways and idea of the paper, and I will be glad to answer any question.
Kose, you're muted.
Thank you, Nir. I thought it was a very clear presentation. Thank you. I think we can, there is time for maybe one question because we are a little bit running out of time. Any questions? Okay. Let's.
Kose, there's a question in the Q&A.
Oh, there is a question. Okay. Okay. There is a question. Could you elaborate on how the security concern is characterized in the theoretical model? Neil,
Yeah, sure.
Take it away. Go ahead.
Thank you. Thank you for the question. So the idea here, you see pi 1 and pi 2. So basically the idea is that when we solve it with security-free concerns, we say that they are equal. So basically the idea is that L1 and L2 security is equal. And this gave us the predictions of the model. When we capture the actual decisions and we have the gap, so in order to explain the gap, we going to evaluate the ratio between pi 1 and pi 2, which is the security. And the idea is because L2 is on top of L1, so our prediction is that the security always be in the way that L2 will be less secure than L1. So there are going to be some chance, some probability that you're going to lose your transaction when you trade on L2 compared to L1, and it's going to be on top of L1. And this is what we find. So when I show you in the end the estimation result. So it means that this is basically the story, that there is some probability of losing your transaction when you trade on L2 relative to L1.
Yeah.
Okay. Yeah, go ahead.
Yeah, like one question I have is, because if you send me a bigger order, it's more likely going to be sandwiched. Basically, people front run you or so, right? So is that also some of the concerns? If you in Ethereum you have more tools to prevent yourself from being sandwich attack or so on. If you're in L2, there's less tools for that. Just something in my mind.
Now, actually, it's a very good question. So I think that in some sense, okay. So first, I also have a paper about sandwich attacks, and so when you look on the data first, L2 has an advantage in terms of sandwich attack because of the high scalability. So because there is more blocks and everything happens faster, so there is kind of like it's less likely that you're going to be front run. And I think that in some sense, if we're going to add sandwich attacks to the model, it can be interesting. It can be, but my intuition, it's actually going to be make L2 be even maybe safer than L1. But it's very, very good point, and yeah, it's a nice feature to add it later. Yeah.
Okay, great. All right, we're going to move on now to the second presenter. That is Ruizhe Jia. Ruizhe, you can share your slides and get going.
Can you see my screen?
Yes.
Thank you for having me. I'm Ruizhe from Columbia University. Today I'm going to talk about price discovery on decentralized exchanges. It's joint work with Axel Capone and Shihao, both from Columbia University. So before I talk about decentralized exchanges, let's first talk about price discovery overall in financial markets. So price discovery is really how the information is being incorporated into asset prices. That's why the price for stock, the bonds, even crypto are in the markets are changing and reflecting the information overall in the market. And it's a core study topic for asset pricing or microstructures. So one thing, if you look a little bit closer about price discovery, like those price change, is you really should think about it closely connected strategy of some agents called informed traders. So informed traders are essentially people have a view on the market. They have a better information on the future price of some asset. But if you really, and they have a view on the market, they want to express their view by trade. And if you really think about them and put yourself in their shoes, whenever you're informed out of the market, you're facing a dilemma. That is how quick you want to trade. That's because you can definitely trade very quickly. You can expect your execution. You can submit tons of market order, large order. You can sweep across all the exchanges. That being quick can sometimes be good because you can trade before a lot of people and make sure you can position your trade for your information before other people. But it can also be bad because sometimes if you make such a strong signal in the market that you may have some information through those trades, you may leak your information, then maybe market maker canceling their orders, some other people are trying to trade together with you, which also increase your impact and trading cost. So potentially you also want to trade slow to higher intention. There are indeed some people randomize their order flow with just trade a small proportion of their daily volume today. So at the core of price discovery, the strategy of informed trader is really important, but it's hard to really look at the dilemma empirically because you really don't observe a lot of things in traditional exchange. You don't observe who is informed trader. You probably infer later from their order type. You don't know their execution strategy. You don't know how much they want to trade in what time horizon. It just there's tons of non-observability. But later I will tell you that at these new exchanges, you actually have a more transparent data, transparent structure, and you even have a proxy for how much people want to pay for their quickness, which makes studying price discovery much easier. So to me, the one of the biggest difference between central exchange and decentralized exchange is their execution mechanism. For central exchange, typically have continuous execution, which means that if you want your order to be executed for other people, you be quick. But for decentralized exchanges, it's actually on blockchain. So the order is executed completely different compared to central exchanges. If you look at this graph, what happens if you're traders, you have some trade you want to do, what you do is you broadcast it across the whole blockchain network. Now, one important thing you have to specify is how much a fee you're willing to pay for your transactions. And after that, validator or now builders are going to put those transactions into a block, which typically they do from the high fee to low fee just to make sure they also earn those fees. So they have incentive to do that. So what happens is that eventually you have this explicit fee bidding mechanism for order executions. What is good about that for us is, for the trader is, if you bid higher fees, your order more likely to be included in your earlier block and in the top block position, so it can be for other people. So it become a proxy. Fee become a proxy for how much you want to pay to trade ahead of other people's. But also there is another thing which is really important is when you trade on blockchain, you have too much transparency because you're when you broadcast on blockchains, you're essentially your order is observed by a lot of people on this blockchain network. And then if you're paying a high fee with some large order, you're signaling to the market that you may have some information, right? So again, you have this, if you're trading too quick by bidding higher fee, you have this information leakage cost. So the tension, the trade-off still here, but now we have a proxy for how much you're willing to pay for the speed. You're paying high fee, you're going to execute before other people, but if you're paying a low fee, you may be able to mix with other orders and higher intention a little bit. So the trade-off still here. And that's why DEX is a really good place to study price discovery, and especially this dilemma between trading quick or higher intention. So the main question we're answering this question, do people or the informed trader on DEX, they're willing to pay a high fee to be quicker executed or execute ahead of people, or they're trying to bid low fee to prevent information leakage and just hide their order among all other DEX orders? So the answer to that question is informed trader actually choose to bid high fees when they face this dilemma. And then the evidence is that if you look at different order flows in this exchange, you actually see high fee order flows, which I will tell you how I classify that, has more correlation with the future price change on Binance or the overall market price. And then because we have blockchain data, which is very transparent, we can push the study a little bit further. We can study what is really the mechanism basically behind people informed trader bidding high fees. Typically, there are two explanations. One is that when blockchain itself becomes so congested, informed trader also bid high fee to avoid not being included in the block. So that's one explanation. Another explanation is like they're just competing with each other because we have this fee auction blockchain mechanism. So to answer this question, we just say competition does exist. That's the reason, because sometimes the informed trader not only pay high fee, they pay excessively high fee. They pay it so high that it's not it's much higher than any order in the blockchain. So it's not really about being executed on that block. It should have some more about competition. So you cannot rule out competition channel. And then we look at mempool data, which is even more higher resolution data on blockchain. We think like the pattern, they really bid that high fee is really like the jump bidding in the auction. So they're trying to deter other people from competing with them by suddenly bid a high fee. So I'll introduce that mechanism later. Now we contribute to several literature like informed trading price discovery because they had ideal steps to check this dilemma between execution speed and information leakage. We also contributed to DEX literature. I think one thing for me is also surprising, and also to a lot of people, academic and also industry, is that people typically think DEX doesn't have price discovery. They just follow the price of Binance. But this paper just tells you that there does exist price discovery. You just need to know where to look at for informed flows. For us, we say that it's like high fee order compose a lot of informed flow because informed trader trying to bid high fees. We also contribute to other traditional literature. Now let's look at the main result and data. So first, the data is that we look at for crypto trading pairs, which has tens of volume in this 1 year period. And also we did do also other analysis, which on other pairs, they're roughly the same. So we have first type of data is executed orders. You see all the trade on both Binance and decentralized exchanges. And also we have the limit order book on Binance, which is, you can check the mid code. So we think we can see, that's our, we can track the mid code of the Binance and see how different flows contribute to that price process. And eventually to get higher, even higher resolution on how people bid in their, to bid their fees, we also have Ethereum mempool data to just look at in between the production of one block, how people are bidding in that period of times. So this gave us a higher resolution. And the main methodology we use is quite traditional, is Hasbrook 1991, which is a structured VAR model. So what happens is that we have these Y variables, which is you have the price change, which is the mid code at Binance. You also have the flow of Binance between T and T-1. And you also have 3 different DEX flows. So why there are 3 different DEX flows is that we classify them based on how much fee they're paying. So if you look at the past 20 rolling windows of blocks, if you're paying above 75 percentile, we classify this trade as a high fee trade. And if you're paying like the middle 50 percentile, we think you're, we classify mid fee trade, and the rest is low fee trade. So this is our Y variable. And we also have this unexpected innovation term, which is like, it's just the innovation term that is expected. And A matrix is really the structural part of VAR model, which is what is contemporaneous effect, what is like, which is maybe affect each other after a block and so on. So definitely you have to make, you got some choice, you can make some restriction here. The one restriction we make is based on our timestamp convention, which is our T and T-1 are the block generation time, because all the trade of DEX happening here, even there's some mid order in the between. So the flows, centralized flow at T is actually the T from T-1 T's total flow on central exchange, and their price change, RT, is also T from T-1. And you can think that the DEX flows, their trade may basically respond to the price change, the centralized flows in that period of time, and and then on the other hand, so we also have different flows. They may, or some of them may have some contemporaneous effect on the others. Those, what I do is we try a bunch of specifications with different permutations, and that's how we generate a lower bound and upper bound of our estimations. And then there are 2 key metrics we're looking at. The first is called permanent price impact. So what is that? It is really, this is the total future response of the price change on Binance. So you can think this is as, if I have some more unexpected flow, say I see a tens of unexpected high fee flow printed out before me, how much this will impact the future Binance price. So this is exactly how you should interpret that, which is how much permanent price impact those trades have generated. So the higher that, especially in the positive direction, means that the more the future price are moving in the same direction of your tradings. And then if it goes to 0, it means that you only have some temporary impact, maybe just goes to 0 in the end. And another thing we can look at is called information share, which is essentially the spirit of variance decomposition, which is how much the variance of the underlying price innovation can be explained by the innovation for the expected shocks for those different flows and the price itself. So those are 2 things we're looking at. This is very intuitive, which is how much those expected trade is generating, is leading to a permanent price income in the future. And this information share is just how much the price movement can be explained by different flows. Now we turn to the result, which is the key question we're answering here, which is, do you inform trader trying to bid high fee to trade before other people, or they're trying to be lower fee to hide among other people? If you look at the result, so the high fee flows, you have a very high permanent price impact, and they're mostly significant. And then, which means that whenever you see expected high flow comes into the market, you're expecting in the future Binance price move in the same direction for this magnitude. But if you look at the low fee, the lowest quantile, you look at sometimes it's not even significant or even the different signs, and then there is really small magnitude. So you can think that then this high fee flow just have much higher composition in terms of informed trading, like trade has information about the future price. And on the other hand, if you're informed trader, most of the order flow probably just go here instead of here, right? Because the composition is much higher here. Even if you just look at the lower bound for this and compare it to the upper bound for low fee, you still have a significant differences. So this really says that the higher flows, high fee flows, indeed have higher composition for informed trading, and informed traders are likely just trying to beat high fee to trade quicker. And then we can also look at the impulse response, which is if you look at this one, which is the centralized return to high fee flow, you see a much bigger magnitude and significant peak at the one, but you still have more follow up. But for the low fee flow, actually not always significant, is always also quite small. And then for the information share, we're going to get the same result. The high fee flow is going to have much higher information share compared to the low fee flow. So all is saying that this high fee flow just have more composition of information about the future price, and then informed trader just picking those, trying to beat much higher fees typically. So we also do two robustness. I'll just go over one. One is control for trade size, because people typically think gas fee is just a fixed cost as the first. But then if trader has a larger trade, then if you think that the per volume fee is just lower, then potentially just large order don't care about fees and they just bid a high fee. And that's why we also know that large orders typically have more information. And that's why we see here you have a high fee, have more informations. But if you do this segregation, if you just look at large orders, those orders, and sometimes the low fee orders even have a higher size than the high fee order. So in this category, the low fee order potentially can have a higher order size than the high fee orders. So if really the large traded size is dominant force here, you should see the low fee, this category should also have a significant impact, should have a higher magnitude, at least at the same level of the high fee. But this is not the case. If you look at the high fee large order, they're still significant, they're still large. But if you look at a high fee large orders who basically have big trade size but low fee, they still don't have a huge permanent price impact on the future price. So this really means that large order is not what generated the result, it's still really the fees. So now we go to the last result, which is the mechanism. So there are two explanations as explained before. First is people just worry about congestion in the blockchain. That's why they just bid high fees to get on the blockchains. But you can think this shouldn't be too much difference between the median of the blockchain. They're a bit high, but probably not too high. But on the other hand, the competition between informed traders, there are potentially multiple private informed traders competing with each other. And when you have competition like that, you're going to what matters is, can you trade before the other people? Then potentially your fee is going to be much higher than the median trade in the block. So we're going to identify some excessive high fee trade, which are trade that has much higher fee than the 75 quantile. By much higher, I mean 1.5 times the difference between 75 quantile and 25 quantiles. So we do see a lot of those trades. But even if you have those trades, it doesn't really mean that those trades are the main cause for our result. So what do we do is, what if you disclude the excessive high fee trade that are likely to be competition trade? Then you rerun the structured VAR. You see that all the results become the difference between high fee flow and low fee flow just drops significantly. So even those excessive high fee trade are just a small amount, but after you remove those things, the main results we have just become much weaker. This really means that those excessive high fee trades which are potentially competition trades, that is one of the main driver for our result. That's why we cannot rule out competition channel. And then, but people think it's natural, right? In a mempool, in public pool, you just have a ascending price auction, then you have one or two informed trader, you're naturally going to pay a very high fee. But this is actually not a cause. What do we do if we look at the mempool data and trying to see if there are people are competing with each other, overbidding each other, do they have this process? What do we see is that actually no, like it's hard to see people who are trying to competing with each other, trying to bid higher fee in front of other. What typically do is they just bid the very, very high fee in their first orders. So you see that they were just very small of trade, just trying to have a recursive overbidding each other's. Most of them, what they do is just, I bid high fee in my first trade. But that sounds suboptimal, right? Why do you give yourself such a high execution cost, even when you don't know if you have a competitor in the very beginning? So what the rationale we think is from something called jump bidding people see from auction theory. What do is that this is, if you suddenly bid a very high fee, when competitors see that, it really discourages them from competing with you. First, if they're competing with, they're going to have a huge cost, and they're a little bit worried about like things like winner's curse, even if they win the auction, right? Win the bidding. This is also not the single force in the blockchain context. If you think about there's some ETF going to S&P 500 going to have Tesla, the hedge fund informed trader going to trying to position their trade before the inclusion. But if you see some other hedge fund is trading very aggressively, you see that, then you potentially worry about, even if I pre-position my trade before the inclusion of Tesla, then maybe I'm trading too much. After the inclusion, I may not earn much money, I may even lose money. So I think this is this strong kind of signaling to prevent people from competing with you. It's definitely in informed trading all over the market. So let me conclude. Because of the unique mechanism of decentralized exchanges, we have this transparency of blockchain, which maintain the information leakage cost. We also have this execution priority fee bidding mechanism, which give us a fee become a proxy for how quick people want to trade. And all those things is ideal setup for us to study price discovery on decentralized exchanges. We think that in this trade-off, at least in decentralized exchanges, the traders prefer quicker relative to hiding their trade. And we do think from the mempool data, it's because a large mechanism from computation and the underlying mechanism jump bidding from to deter other competitors from competing with them. Thank you so much. That's it. Yeah. Kose, you're muted.
Thank you, Ruizhe. Very nice presentation. We have time for a couple of questions. Any questions? So then let me ask a question, Ruizhe. Are you, the way I'm thinking of this in the microstructure literature is the order flow, the size of the order, right, is important for the market maker because, typically bigger order flows might be from informed traders. Right. That's one aspect. But here you're bringing very nicely another dimension, that is, there is an independent measure of the urgency with which you want to trade. And as you remember from the multiple informed trader papers, yes, so when you have multiple informed traders and you have private information, you do want to trade faster. You want to trade faster, not just aggressively in terms of your large order flow. So what is happening? So tell me what is happening to the importance of order size in this setting? Yeah.
Well, I think definitely even in these new exchanges, despite that both high fees and I think
order size, yeah.
But the high fee and the order size are both important. If you look at one of the segregation, you can see that in this category, like which is from 0% to 90 percentile, the high-fee flow indeed are correlated with higher order size. So it's right that I think a lot of time high-fee flow and order size are correlated. And
Okay.
yeah, so indeed, like sometimes if you're informed, you not only bid high-fee, but you also have a higher lot size. So the robustness, what they do is, what if we are trying to have some segregation of the trade flow, look at some specific trade flows where the trade size and fee are no longer correlated. Then basically or they're even in a different direction. If you look at that, those those low fee flows in this category actually have a larger trade size than the high fee flows. So if you're thinking about, then if it's really the large trade order that's generating the result, then you're gonna think this one gonna have a higher permanent price impact because they're larger, right? But then in reality, you're like, actually, it's the high fee flow, even though, which is here, that have permanent price, which means that those order flow, even despite they have a smaller trade size relative to this one, they have a higher permanent price impact. So what they do here is we admit that there is a correlation between high fee and large size for a lot of cases, and this may be hard to segregate. They may jointly contribute to this price discovery. But if you look at this special group, then you find that it's really the high fee that is making a contribution here. That's why one cannot rule out the trading quick component relative to the size component. Yeah.
Okay, very interesting. Any other questions?
So I have a question.
Go ahead, Neil.
Can you go back to the conclusion?
Oh, yeah.
So when I did one of my projects about sandwich attacks, we also use mempool data. And surprisingly, we observed that many transactions execute directly without going due to the mempool data. I did it with another computer science guy, so I less know about the technical aspects, but Aviv is an expert on that. But the idea, I guess, that they are kind of work together with the block builder and skip this part. Do you have something to say about this, and you observed it in your data?
Yeah, this is what we control. We do another robustness, which I didn't have time to go over, which is controlling for private pool. Because as you say, like 2021, now you have flashbots, which is essentially they have some MEV protections, and after that, you also have now PBS, which you have MEV boost, which are you can direct contributors. You do see that the fraction of private volume is going large. So you can see from this graph now, like maybe 30%, no, like not probably even larger, but back to the August 2021, even like 40-30% of trade going to private pool. And we do identify those private pool transactions based on their fee, their position on the block and so on. And what do we see? And we also do another set of analysis, which is including the flow probably go to flash or other things. So you see that, yes, those transactions are informatives, but potentially they're not always informed because they're, as you said, mingle with other transactions like sandwich, other MEV things. So they're not always very predictive of the future or permanent price impact. But let's think a set of that. Even if you have some flow going that channels, in the mempool, you still see that in the high fee flow is having much higher price impact than the low fee flow. So the result still remains, but you do see that some of the magnitude of the permanent price become lower. My speculation is some of the informed flow goes to DEX, would go to like Flashbot or those private channels. And the reason why don't you have this very big number here? Because if this is not here, probably it's going here, then why is this still only 1.16, very small? It's exactly as you said, because people use private pool for so many uses on DEX, right? They use for MEV, sandwich, cyclic arbitrage, and so on. So like not only informers that become so noisy in that flow, eventually you don't have a huge permanent price impact here. But the result between high fee and low fee still remains, and DEX flow is dark, which is flashbot, where bidder flow is indeed has permanent price impact. Yeah. I hope this answers your question. Cool.
Thank you, Ruizhe. Okay, I think we're going to go on to the third paper. Aviv Yaish is going to present the paper. Aviv, you can get ready with your slides.
Can you see my screen?
Yes, yes.
Okay, so I'm going to present a paper called Speculative Denial of Service Attacks in Ethereum, which is joint work with Ruizhe, Ruizhe, Aviv Zar, and Arthur Jervey. So in this paper, we try to examine the transaction fee mechanism in Ethereum, and specifically its impact on the security of Ethereum. So I assume that most of you have heard about this mechanism, but just in case, in Ethereum, transactions can invoke arbitrary pieces of code as long as they're on the blockchain. And these pieces of code, because they can be arbitrary, they may have different computational complexity, and thus processing different transactions may incur different computational costs. So to account for that, in Ethereum, each unit of computational complexity that the transaction requires is measured in a unit called gas. And the transactions that enter the blockchain, that wind up in a block on the blockchain, pay their transaction fees proportionally to the amount of gas units that they consumed. Furthermore, transactions in Ethereum can revert. These are transactions that are in a block on the blockchain, but for some reason they decide to cancel any changes that they've made to Ethereum state. And surprisingly, even transactions that revert have to pay fees up until the moment they reverted. But if you think about that, that's actually not that surprising, because this is a defensive mechanism against denial of service attacks. If transactions that revert would not pay any fees, that adversaries could easily create very complex transactions that always end up reverting. And under our hypothetical scenario, they wouldn't pay anything. This would in turn waste victims' computational resources, and we don't want this to happen. So in Ethereum, even transactions that revert have to pay fees. And supposedly, this should prevent these types of attacks. In this paper, we show that actually, this is not the case. This is not the case because transaction fees can only be paid by transactions that enter a block. And if transactions are never in a block, never wind up in a block on the blockchain, then they never pay any fee. So why would any blockchain actor process transactions that never end up in blocks? So let's say that we're a block builder or a block proposer. We're the person who's creating the upcoming block. And we have currently a block that's full, completely full. It cannot contain any new transaction. And we have heard about a new transaction that appears very lucrative. It appears more lucrative than maybe at least one transaction that we have currently in our block. The rational thing for us to do is to kick out one of the transactions in our block and put the new transaction instead, right? Very reasonable. But the transaction that we kicked out is not in the block. So on the one hand, we had to execute it in order to put it in the block. Now we kicked it out. So we cannot collect the fees that are supposed to compensate us for executing it. We call this generically speculative investment of resources in transactions. Okay, this is one manifestation of it, but we'll soon see a few more. So we rely on this insight to present a few attacks. All of these attacks have in common one thing. Our goal is to lower the revenue of ecosystem actors. And this is valuable because us, the adversary, we may be part of this competition. We may be a staking pool. And by taking competing staking pools, we increase our profits inadvertently. We harm our competition. Maybe the stakers active in the staking pool would drop out from that pool and join us, right? It's beneficial for a variety of reasons. So we present multiple attacks, and to measure their impact on Ethereum, we execute them on a local private testnet of real Ethereum nodes. So we set up these nodes. They use the real code. It's not a simulation. And this is important because although Ethereum and other cryptocurrencies have white papers and even academic papers that describe the mechanisms that these cryptocurrencies use, and actually it's quite common for cryptocurrencies to have mechanisms that are not well documented, if documented at all. So Ethereum clients actually have accumulated a very, very thick layer of defense mechanisms against attacks such as our own. These are usually not documented anywhere, sometimes not even in the code. So we had to test out our attacks somehow. And by testing them out, we showed that they actually work. So the crowd here are supposed to be economists, and Kose said that I should somehow pick your interest. Why should you be interested in this paper? So our attacks are economically motivated, and they rely on the mechanisms, the economic mechanisms put in place in Ethereum today in order to work. This is maybe the best opportunity for researchers here, young, well-known, whatever. There is so much space to work in here. For example, in designing proper mechanisms that actually work and that prevent work from people like me. So pay attention. There's literally a goldmine here, I think. So in this paper, we present 3 classes of attacks, which are supposed to target different mechanisms that Ethereum nodes use to make sure that transactions that they invest resources in would eventually wind up in a block, and thus they would be able to collect fees from them. So one technique that nodes use is obviously to execute transactions. That's the fail-safe way to do so. And for that, we produce a class of attacks that we call conditional exhaust. Other nodes, maybe even the same node, may use heuristics before they try to execute transactions to weed off transactions that obviously are invalid and cannot be included in the block. So in that case, we present a class of attacks called membrage. Finally, some actors in the ecosystem use reputation mechanisms to prioritize transactions created by actors who usually create transactions that wind up in a block on the blockchain. So in that case, we present an attack called ghostix. So before I proceed, I'll just briefly say that in today's Ethereum ecosystem, there's a variety of actors who are involved. And at least for the first 2 attacks, we focus on 2 types of actors, on block proposers and block builders. These are the people that create blocks. They collect transactions from the peer-to-peer layer and put them in a block, which winds up on the blockchain. In our first attack, conditional exhaust, we target proposers and builders. So in order to create a block that contains some transactions, these actors must eventually execute the transactions that they want to put in the block. In this attack, our goal is to try to trick victims, to try to trick proposers and builders, to waste time on executing our transactions, adversarial transactions, that cannot be included in blocks. This is useful because if we cause our victims to first try to process our transactions before they try to process other transactions, we can waste their time. And in Ethereum, for example, the time window in order to create a block is very short. It's 12 seconds. So if we waste enough time, we cause our victims to not be able to execute any honest transaction, any non-adversarial transaction. And thus, they would create empty blocks and not make any money, or at least make less money. So I'm going to present one variant of the attack, which relies on assuming that censorship is prevalent in the network. The paper has other variants which do not rely on this assumption. So what's censorship and why is this a valid assumption? Probably you guys have heard that 1 year ago, the US OFAC decided to sanction Tornado Cash. Tornado Cash is an Ethereum platform. It's a smart contract that runs on Ethereum. It has an Ethereum address. People can send funds to Tornado Cash to an address which corresponds to tornado cash. And this can allow them to, for example, launder funds. So if ecosystem actors such as builders and proposers want to be compliant with OFAC's sanctions, they commonly simply censor transactions that send funds to addresses corresponding to tornado cash. So when I say censor, I mean they never include such transactions in their blocks, at least not intentionally. And judging by the data, censorship is very prevalent. So in roughly 75% of blocks over the past about 2 or 3 weeks, all blocks were censorship compliant, created by actors who are known to be censorship compliant. So this is a valid assumption. It's valid to assume that actors commonly censor transactions. How can we use this to cause victims, to cause nodes that censor transactions to waste their time on transactions that can never be included in the block? So to do that, we create transactions in the following manner. Our transactions invoke code that, first of all, checks if the upcoming block proposer, or maybe the block builder who's currently building the block, is censorship compliant. And this is easy because Solidity, the language that is used to write code that runs on Ethereum, allows to check that. If the current actor is censorship compliant, we execute very complex code. This code culminates with a transfer, with a minimal transfer. We transfer one way to some sanctioned address, for example, to tornado cash. So one way is the smallest amount of money you can transfer. It's dust, it's nothing. If the current actor is not sanction compliant, the transaction ends here, doesn't do anything else. So how can transaction like this help us? In the general case, proposers cannot simply look at a transaction and decide without running it that the transactions are sanction compliant. They have to run them. So when they run it, we trick them into running complex code, which takes time. When they see that the transaction is not compliant, they understand that they wasted their time. They cannot put this transaction in a block without without being non-compliant with US laws. So they cannot put it in the block. On the other hand, if this transaction somehow winds up in the hands of a non-censorship compliant actor, then our adversary does not have to pay a lot. Because payment is proportional to computational complexity, if our adversary would pay for the complex branch of the code, that would be very, very costly. We don't want to incur this cost, so we choose a simple branch. And this simple branch corresponds to 23,000 units of gas. That's roughly 10% more than the simplest Ethereum transaction that can be created. So while our transaction consumes 30 million units of gas, which is the maximum amount, we pay roughly 1,270 times less than we used. So to evaluate this attack, we ran a testnet, we ran a local node using a computer which has a much higher, much stronger specifications than the minimal recommended amount, at least an order of magnitude stronger. And we show that in spite of using a beast of a machine, we can create 140 transactions, thereby causing this beast to not be able to execute even a single transaction that is not adversarial. Our victim first tries to run our transactions, then runs out of time, does not have enough time to run any other transaction, and thus always creates empty blocks. To do so, we have to attach a high fee to these transactions because nodes prioritize transactions greedily. They pick the higher fee first. If we choose a fee that's higher than 90% of transactions, at least the Ethereum transactions sent over the past 6 months, the total cost for this attack for 140 transactions is at most $770. That's not a lot for what we're doing here. So in the paper, we present other variants, for example, a variant that does not rely on censorship. And we show that the attack can be made even cheaper using very simple techniques. I encourage you to read the paper. And before I proceed with other attacks, let me briefly mention two really great works. The first by Hess, Kiefer, and Searer from 2016. The second by Perez and Lifshitz from 2020. They cover related attacks. The first attack was never possible. It was only theoretical, but it has some relation to our attack. The second attack was possible for some time, but was mitigated. Again, related to our attack. I encourage you to read them or our paper to understand the differences. Great. So let's move on to the second attack, to the second class of attacks, membrage. Transactions, before they're put in a block, they are stored in a data structure called the mempool. At least in Ethereum, it's called the TX pool, but in Bitcoin and other cryptocurrencies, this data structure is called the mempool. And as the amount of memory is limited, obviously the mempool must be limited as well, and thus can only store a limited amount of transactions. Once an actor has a full mempool, if it hears about a new transaction, it has to decide whether it wants to kick an existing transaction out of the mempool in favor of the new one, or ignore the new one. In this attack, our goal is to trick victims to kick out profitable transactions from their mempool in favor of invalid transactions that cannot pay anything. This obviously decreases the ability of our victims to make a profit because they have less transactions, less valuable transactions to choose from when constructing blocks or when doing whatever they want to do. Again, there are a lot of variants of this attack in our paper. I'm going to cover just one. So before I do, let me briefly explain how the mempool works. So obviously, it's not possible for actors to verify that an incoming transaction is definitely going to be valid, definitely going to be possible to put it in a block in all permutations of the transactions that are in its mempool. So a transaction's validity may depend on Ethereum's state, and the Ethereum state may depend on the transactions executed before the current transaction. So ordering of transactions plays a major role here. And when an actor hears about a new transaction, the validity of this transaction may depend on the order in which it positions transaction in its upcoming block. And thus, it has to go over all permutations. To rule out very obvious cases in which transactions are not going to be valid, nodes use heuristics. And in a very, very great paper by Li, Wang, and Tang from 2021, these authors noticed that the heuristics that are commonly used can be easily tricked. So we can trick nodes into thinking that the transaction is going to be valid when in actuality, it's not going to be valid. And unfortunately, at least for me, unfortunately, they introduced all kinds of mitigations for their attacks, meaning that for my attack to work, I had to work harder. So they prevented the attacks that they proposed, and even nicer thing to do was that they implemented it in Get, in Ethereum's most popular client, meaning that nodes that run an up-to-date software should be vulnerable against their attacks. But in our attacks, we circumvent their mitigations, and we show that these attacks work on up-to-date software. So again, before I proceed with describing the attack, I have to give you some more background details. So in Ethereum, users can specify the order in which they want their transactions to be executed, and this order is enforced by the consensus of Ethereum. No one can bypass this order. So if, say, I have a transaction which I want to put first in the order, everyone must abide by that. To specify the order, transactions have a field which is called the nonce. This is an integer, which is literally an index. So if I have a transaction which was already included in the block and has a nonce equal to 1, then the next transaction that anyone would be able to put in a block, which was created by me, must have a nonce which is equal to 2. And if I first send a transaction with a nonce equal to 4 without sending a transaction with a nonce equal to 2, before that, this transaction with an index of 4 can never be put in a block. So in order to distinguish between these two types of transactions, those that can be immediately put in a block and those that cannot be, Ethereum adopted a terminology calling immediately placeable transactions as pending transactions, and those who are not, who cannot be immediately be placed in a block are called future transactions. So in fact, even if I had sent this transaction before this transaction, again, the future transaction cannot be put in a block. And that is because I didn't create a transaction with a nonce equal to 3. So nonces must increment by exactly 1. Great. So again, transactions that can be put in a block immediately are called pending transactions. Those that cannot are called future transactions.
Aviv, 3 minutes.
Yeah.
Yeah.
Okay. So I won't go over the mitigation. The mitigation is put in place by previous works, but to give you a brief overview of how this attack works, we assume that our victim has its mempool full. Its mempool is full of existing transactions that pay some amount of fee. Let's say, for example, fee. If the mempool of our victim is not full, we can fill it. In our first phase, the first phase of the attack, our adversary creates a chain of transactions with consecutive nonces that pay fees that are slightly higher than the fees paid by existing transactions, and it creates enough such chains to clear out the entire mempool and replace all transactions with its own transactions. These transactions are still valid. They can be put in a block. To make sure that they're invalid, we replace this chain with a new chain. This new chain starts with a transaction that replaces the first transaction in the previous chain. To do so, we simply set the nonce to be equal. This allows replacing that transaction. And we pay a slightly higher fee to make it profitable for our victim. Now, the rest of the chain moved to the future queue. It cannot be immediately executed. Then we create the tail of the new chain, and each such transaction transfers all of our adversary's funds to some other address. This means that our adversary cannot pay for both the first transaction and this tail, because in the first transaction, our adversary transfers some amount of money, meaning that it cannot transfer all of its money afterwards. If it had 1 ETH before this transaction, it has less than 1 ETH after it, and so it cannot transfer 1 ETH in this transaction. This means that once the first transaction is put in a block, the rest become invalid. But it's impossible to verify that the rest become invalid because our victim does not have one transaction that fills the gap between the first and the tail in the chain. In order to verify that indeed the tail is invalid, it must know what came before that. Then our adversary completes the chain and sends a transaction which when the victim sees, causes the victim to transfer all the future transactions from the future part of the mempool to the pending part of the mempool. But again, our adversary cannot pay for these transactions. So we tricked our victim into evicting profitable transactions in favor of transactions that are not profitable. In the paper, we present a more refined version of this basic attack, which allows an adversary to evict roughly 82 transactions. And when doing so, our adversary would pay at most for 2 transactions. So that's quite cheaper than paying for 82 transactions. So, Kose, how many minutes do I have left? You said...
Actually, 1 minute.
1 minute. So I won't go over the third attack, but it's also cool. I encourage you to go over the paper and check it out. So to conclude, in this paper, we show that something that our community, the academic community researching blockchains, thought was well understood. Transaction fee mechanisms. We've all heard about it. Probably in one of Tim Rothgarden's countless talks that caused many economists to go into blockchains. So there's a lot of papers on transaction fee mechanisms. Why should anyone research that topic when it's well understood? Well, in fact, it's not well understood. We understand transaction fee mechanisms, at least when it comes to transactions that eventually enter blocks. What about transactions that never enter blocks? This is completely unresearched. This is a Wild West and ripe for very fun, very cool research, especially for economists who specialize in mechanism design, who can maybe design mechanisms that prevent such attacks and make Ethereum a safer and easier to use system for regular people. So that's it. Thank you.
Thank you, Aviv. Very nice presentation. I'm convinced that we have a number of research things to do here. So I'm going to look at your paper very carefully. By the way, are there any questions? We have a little bit of time for questions, but not much.
Can I ask a question?
Yes.
So, Aviv, strategically, this kind of attacks, can you give some intuition which users you think may now or after reading your paper use this attack? And also, do you think that maybe competition between networks also make that other blockchain networks community will attack Ethereum to make it be less attractive, or whatever you have in mind?
So it depends on how you model these communities, right? If you attack Ethereum, Ethereum is maybe one of the poster childs of cryptocurrencies, and if it's attacked, it's reasonable to assume that the headlines that would be generated by such an attack would affect other cryptocurrencies. If you look at the exchange rates of cryptocurrencies, they kind of move in unison, kind of, not always the case. So I don't know about that, but about the types of users who may want to execute such attacks. So you can think, for example, about builders. Builders are quite sophisticated, and they have a lot to gain from, for example, conditional exhaust, right? By causing other competing builders to not make any profit, they essentially drive their competition out of the game. And for memperage, that's also the case, right? You can cause your victims to pick out profitable transactions. They have heard about them in the past, but now they're not aware of it because it's not in their memory, right? You, for example, if you're a builder or you're a proposer, whatever, can use these transactions when you're constructing your block, right? Does this answer the question?
Quick question. Just curious. I think there are actually small sub questions. First is, I think one builder typically also trying to offer the service, which is if you transaction fail, probably don't even get unblocked, especially if you're doing some MEV, and that can potentially and that's why they have to simulate a lot of things, right? That's why some people can potentially do that. Is that true?
So it's true and catastrophic. Okay. Just a second. So this is one of the techniques that can be used to make our attacks cheaper. Flashbots, for example, allow you to specify if you want reverted transactions to never be included, right? And this is tragic. And that's why they had to resort to reputation mechanisms. So reputation mechanisms, when I say reputation mechanisms, I mean specifically the reputation mechanism used by flashbots. But when you think about that, what else can you do? You have to have some kind of reputation mechanism. If transactions that never entered a block cannot pay for anything, then how can you prevent this from happening? You have to have some kind of reputation mechanism, which accounts for the amount of transactions that you created that eventually wind up in the block, right?
Second is have a little bit more worry, which is if this is true, right, then potentially censorship can be even stronger, which is because a lot of them have a lot of builders have some trading also. They may just include their own transaction, right? They may even censor even more, like they don't even include like transaction that potentially can give them any type of a risk because they don't want to risk the money they lose from centralized arbitrage. So that's yeah, that's just a worry. Like the consequence of the attack is probably is even more censorship.
Yes, that could be one thing, like one consequence. But there are some transactions which are guaranteed to never behave in that manner. For example, very simple transfers, money transfers, can be verified very quickly, right? And also, if we dive a bit deeper, then you can classify Ethereum code into code that is static, does not change the state, and thus is easy to verify, and code that is not static. So with respect to what you said, that's an excellent observation. And if actors who may be victims are completely risk averse, they may want to avoid such non-static transactions. And one of our mitigations is was a suggestion to adopt some kind of like a place in between. Transactions can clearly specify where they will, like which changes they will make to the state and which they do not, in a way which is enforceable. So currently, Ethereum has such a mechanism which is not enforceable. But we suggest to make it enforceable. This allows to kind of give you like a sweet spot between these two categories.
Thank you. Makes sense. Yeah.
So thank you. Let me just thank each one of the presenters. You guys are doing a great job. And all good luck in the job market. By the way, if I can help in any way, send me an email and let's talk. Okay? All the best.
Thank you, Kose. Bye-bye.
Bye.
Thank you so much.
Thank you.
Bye-bye.
Thank you.
Bye-bye. Bye-bye.